Could stocks benefit from central bank investments? That's the question being asked by some economists ahead of Thursday's meeting of the European Central Bank, which meets to decide if it should expand its current bond buying program. The reason this is even being discussed? The ECB is running out of bonds to buy. Joining us now to discuss is WSJ reporter Tom Fairless in Frankfurt. Tom, thanks so much for being with us.
Thank you.
So, Tom, the bank is already purchasing about $89 billion a month of corporate and public sector bonds to reduce the interest rate across the Eurozone. Where is this fear of running out of bonds to buy coming from?
Well, the program has been running already for 18 months. They've amassed about €1 trillion of public sector debt as of last week. The market is obviously bigger than that, but they've imposed constraints on themselves, partly for political reasons, which say they can only buy a third of each particular bond issue. So they can only buy a third of the German government bond market, for instance. The problem with that also is they have another constraint which says they can't buy bonds yielding less than minus 0.4%. And that rules out a huge swathe of German government bonds which are yielding less than that. So the actual market they're buying in is much narrower than the wider government bond market.
So that pool is shrinking then. So how would a move by the ECB into equities impact Europe's stock markets?
Clearly, there'd be an impact on prices. If you look at the corporate bond markets, where they announced their intervention in March, the prices have gone up, despite Brexit, which has been a shock for the whole region. The magnitude of the impact clearly depends on how much they're going to buy. It could be huge. The Hong Kong Central Bank, for instance, in the late 90s, during the Asian financial crisis, bought about 10% of the Hang Seng Index.
Mm-hmm.
That pushed up prices 40% within 2 months, and they doubled over the next 18 months. But it depends on the magnitude of the intervention.
So looking at this case, the market cap of listed Eurozone companies was $6.1 trillion in 2015, I believe. So do you think stock purchases are looking likely here?
The ECB has never ruled them out. And indeed, Mario Draghi, the ECB president, said when they were considering how to do QE about 2 years ago that they'd considered buying everything except gold. So it has been on the table. The question is, how willing are countries like Germany and other fiscal hawks to go along that route of buying equities, which are clearly riskier investment than bonds?
Sure, and there have been other central banks, like Switzerland's central bank and the Bank of Japan, that have already invested in equities. What's the experience there been, and are there real advantages to doing so? What are some of the downsides as well?
Well, the hope is that buying equities will have a similar impact to buying bonds, that it will boost stock prices, that will boost household and business wealth. It will lower financing costs for the businesses it will lower equity finance costs for the businesses whose stocks you're buying, and that will boost consumption and investment. So that'll regenerate growth, restart inflation, which is what they're after. The risks are that you're picking winners once you start buying stocks. That's clearly a problem with corporate bond purchases to a point which they've overcome. Equities are also risky because they're more volatile than bonds. So for the central bank balance sheet, that's a concern.
All right. Well, I'll be watching what the ECB decides. Tom Fairless in Frankfurt, Germany. Thank you for that.
Thank you.